For this episode of the podcast, I wanted to talk about China and Chinese stocks. They really were the story of this past week. We had very positive news from the China government that they were going to really begin to stimulate their economy, really begin to assist companies that are publicly traded in propping up their share prices. I mean, they were that specific and they lowered interest rates. That news was really well received on Tuesday, and stocks really rallied. It didn't end there. The market rallied on Wednesday, Thursday, Friday. It was a really positive week for China stocks. What's also interesting is that the drawdown on China stocks has been extensive. Stock prices have been going down since 2021, 3 years of stocks going down that for China stocks. Now, at the same time, the last 2 years of US stocks have gotten really high priced. And as I look at the next wave of good investments that are really going to perform in 2025, it is getting harder and harder to find really good value in the United States. Whereas when I look at China stocks, the fundamentals show discounted companies. The PEs are really low. The free cash flow is being produced really high. Balance sheets are very healthy. A lot of these companies have far more cash on their balance sheet than they do debt. Simply stated, it is very easy to find discounted stocks out of the China stock pile. So therefore, if this week represents the beginning of an upward trend and we're early on a China cycle, I want to take advantage of it. I'm going to stay really closely connected to this part of the market because this could be how I can make 2025 a very successful investing year. 2024, now that we're pretty much ending September, has been a very good year for my portfolio. And last year, 2023, my portfolio did really well. So 2 years in a row. How can I make it 3 years in a row of having fantastic returns? Well, China might be that next area of stocks that really take off. One quick example is Alibaba for me. It's one stock that I do own. I've owned it for over a year, and it wasn't performing all that great up until this week. Now I'm up 35% on Alibaba. It went up about 20% this past week. What a rise. And I think it's going to keep going up. When you look at the drawdown on Alibaba for the last 3 years, this stock was trading above $300 a share in 2021. Now it's about a third of that. It has a lot of upside to go. It could double and still not get up to the all-time high that it once had. So there's just a lot of opportunity in this space. And I think we're early on the cycle. In this podcast, I want to share more economic news directly from China and also maybe look at some super investors who had opinions on the China stock rally, get their input on how long this rally would last, and end with looking at stocks that are in this basket of China stocks and share with you what I intend on doing as I look at these stocks during the month of October. We've got a good community of long-term investors, like-minded investors going. And I wanted to ask for your sponsorship of this community and channel. There's 3 sponsor levels that you can support the channel with the first being a $10 program, and the details are on the channel page. There's a $25 program, and then a $100 program for those that would want more one-on-one time. Take a look at the 3 options. I would really appreciate any level of support you can lend the channel, and I appreciate your consideration. Looking at the Shanghai Stock Exchange, you can see that over the last 3 years, there's been a big drawdown in that market. They hit their all-time high in the year of 2021, and since then, the stock market has really tumbled. It's down 16% collectively over the last 3 years. But just a couple of weeks ago, it was down 27%. So it's really recovered quickly and nicely. At the same time, if we compare the Shanghai exchange to the NASDAQ, you see that American stocks have really just outperformed the exchange in Shanghai. In this case here, I'm actually going to compare it to the S&P. These two exchanges were somewhat correlated. They were around the same place all through the 2020 year. And going into 2021, the separation began. And while American stocks really took off and I believe became a little too expensive, the China stocks were really beaten down. You could put a little bit of the blame on this on COVID. In fact, a lot of it, starting with some of the shutdowns that were instituted in China were pretty aggressive. They would shut down complete companies, industries. That was really hard on those companies, and it created a lot of pessimism, a lot of doubt, a lot of fear and concern that would those companies make it? So they've gotten through COVID, which is good. Now, when they shut down those companies, they created supply chain issues, which created another issue. Since there was no supply, there was excess demand, and that affected the whole world. That's why inflation went up so high. And it really kept those stocks really down. So another way of looking at it is the difference between American stocks and China stocks is the opportunity. I could see the China stock market recovering a lot of lost ground and really going up quickly and for a long time to catch up to the valuations of US stocks. As I'll show later, I'll show you a few examples where these companies that have seen significant drawdowns, discounts on their stocks of 70% or so, they're actually bigger from a revenue level, cash flow level, if you compared their numbers today to 2021. So you're getting a bigger company with bigger enterprise value, with greater cash flows, with a balance sheet with more cash today at a significant discount when compared to 3 years ago. So that's where the opportunity begins for me is if this rally is sustainable, it has a lot of room to go. China stocks can really run up to catch up to where they would naturally be from a valuation standpoint if COVID wouldn't have impacted their economy so bad. Now that the government is really supporting businesses in China, I think they're adding fuel to these company stock prices, getting back to fair value. Let me illustrate one example. Alibaba. Alibaba, very popular stock. It's the biggest cap in China. And when it began to sell off, it went down a total of 78% in value. Holy smokes. That is such a drawdown. And it really has been beat up. When we look at the 1 year, the picture isn't so bad. It's a 25% return over a year. And if you look at the last month, it looks pretty good, up 35%. But you could see that there is a lot of room to go to get back to where it once was. It was trading above $300 a share, and now it's roughly at $100 a share. So it could triple in value just to get back to even with where it was in 2021. Let's take a look at Alibaba's revenues and see what has happened over the last 3 years, as well as cash flow and as well as the balance sheet. Alibaba's revenues are higher than they were in 2021. In 2021, this was a $717 billion business measured in the currency in China. And now they are 950 Chinese yuan billion. So that's substantially higher from a percentage perspective. So you're getting a bigger business from a revenue level when compared to 21. Yet you're seeing a massive drawdown from the peak to the trough, 78%. I'm not seeing 78% decrease or nowhere near that in revenues. I'm actually seeing green on the screen. I'm seeing green numbers in growth for Alibaba. The balance sheet for Alibaba looks much better if you look at 2021 compared to 2024. The cash balance and short term investments are pretty much close to the same, a slightly lower amount. And the reason for it is they've bought a lot of their shares back, which is always good for shareholders. So when we look at the share count for Alibaba, the common shares outstanding have gone down from 2.7 million to 2.37 million. They've bought back over 20% of their shares back. So fewer shareholders should mean higher stock price. Again, during that time, the stock has been drawn down. The stock price has gone down, opposite to what this is supposed to do. I'm just showing one more element of value in Alibaba. And I believe this is going to be played out in other stocks in China as well. So the balance sheet in much better shape. Investors that own shares own a bigger percentage of the company now because a lot of shares were bought back in Alibaba. All those things are positive for shareholders. Looking at Alibaba really reinforces the idea that a lot of these stocks have really been beaten down and are priced well below their fair price. I showed some details behind Alibaba that are quite compelling to me, and I hope you find them interesting. Most of the other companies on the China Stock Exchange rallied this past week, and NetEase had a really good rally. JD, which I created a video on, had a great rally. And really, all the top 15 stocks had a very good week, just showing that the whole market really is seeing a lot more investment. I'm going to be spending a lot of my analysis over the coming weeks researching each company. You'll probably see a lot of videos on these companies. I've got recent videos on Alibaba and JD, but I'll be creating videos for all these other companies that you see on the list. So I shared my perspective on China, some of the elements that I believe are going to create a longer term rally. Now, let me share a video of some people that are actually located in Asia that reported on Bloomberg and get their comments on what they're seeing.
Yeah, we really think that China policymakers went above and beyond expectations this time. Sure, some of the interest rate cuts, triple R cuts were expected, and actually yesterday markets were kind of giving back gains in early trading before the real surprise, which was the PBOC facilities for stock purchases. So a couple of things stood out to us. One is that, policymakers are finally realizing that drip fed stimulus was not working and that they needed to come out with a big jolt. Second is that, the national team support that we've been tracking all year is now officially sponsored by the PBOC. So, the central bank is telling financial institutions, corporates to borrow from us, leverage up to invest in the stock market. So the market does not need to question if, the national team is in play anymore. So overall, I think these measures are some of the broadest and most direct that we've seen. Yeah.
Big question, is it going to last? I mean, some say this be just a technical bounce. What separates that from being something more structural?
I think we're going to be on a sugar high for a while, particularly given that the Fed and PBOC are finally on the same easing cycle. Valuations are going to move first. And for China, single-digit valuations have quite a bit of room to go before kind of reaching that 5-year average of 11 to 12 times. For sustainability, it will come down to the data showing improvement we need to see improvement on consumption, housing sector activity, and deflationary pressures ease. And if we get that, we think that the setup it would be a pretty good setup for stocks going into 2025.
Right. There are the elections, of course, and geopolitics, which we can get to in a moment. But Stephen, I'll bring you in. In the meantime, the sugar high, the sugar rush has taken China below 7. Is there a lot of momentum behind that move? Can that continue?
Yeah, I mean, we have to distinguish whether the latest bazooka, as you said, will really help the economy. We'll leave that to the economists, but at least for China, it's always sentiment. Chinese stocks, Chinese currency, it's always sentiment that drive the near-term movement. So as you can see, the offshore yuan actually tests 7. Now it has rebounded, but now at least it has broke through the 7, the highest level since last year, basically. And onshore yuan, it's a matter of time that it's going to break 7 again. As Martin said, the Fed has really helped as well. PBOC also delivered a lot of stimulus. So the currency, actually the direction will be intact. Of course, how fast the yuan will rally, it depends on how the PBOC will let it. Now, if you look at the basket, interestingly, it's actually not that strong. It's still at 98.5, which is somewhat stable this year, meaning that there could be a lot of room for the dollar yuan to drop from here.
But you're saying there's still some cracks that we have to look ahead to. What does it look like post-U.S. election when you have to talk about trade wars once again?
I think beyond all this stimulus hype and also beyond the U.S. election, obviously the top risk is the U.S.-China relationship, because we don't know who's going to win. If Trump comes on, obviously there could be a U.S. trade war 2.0. But even if it's Kamala Harris, we know U.S.-China relationship is just going to go south because of his reason. So that could be a risk premium that's yet to be priced in the yuan. And of course, at some point, people will look at whether the Fed will cut all the way below 3% next year. If not, then the Fed rate cut path will have to be repriced. That will support the dollar. So from the dollar front, that will actually sort of slow the yuan rally as well.
We're counting down to the U.S. elections, as Stephen was pointing out. Marvin, geopolitics, when that kick back in and remind these equity markets that there is something to talk about there.
Yeah, I think, with the stimulus, the big announcement yesterday, the question becomes, has all this easing been front-loaded ahead of the U.S. elections? And if we do get more tariffs, does the Chinese policymakers have more firepower? And we think that it remains to be seen, but the external risks are definitely there. But we think that with this recent strengthening in the yuan, and if the Fed continues to ease as expected, there is room for more policy easing going forward. And I think that sentiment was kind of reflected in the announcement yesterday when some of these measures were hinted that they can be extended if necessary.
What does it mean? We saw a lot of momentum in the equity market kind of take some wind away from the bond rally, right? Where CGBUs actually rose on the back of this announcement. Has all this been priced into the bond market? And should we find a floor for yields now?
I think CGBUs, especially the 10 years, sort of rebound from record lows yesterday, which is quite counterintuitive because it's like a massive stimulus rate cut, triple R cut, and even forward guidance for more triple R cut before year end. So you would have expected yields to drop lower. But now that tells you that China, after all, is an EM market. So better sentiment will actually sort of help yields. So the growth story, at least for now, is baked in. So people expect recovery in the property sector, in the real economy, and 10-year yields, which reflects the macro sentiment, actually sort of rebound from here.
Very quickly, final thoughts, Marvin. How do I position in the equity markets right now?
Yeah, so similar to the Fed easing that has broadened out the U.S. market from the Mag 7, we think China easing will kind of broaden out sector performance. So this means we're looking at some of the laggards, consumer staples, healthcare, and real estate. And also it means that we think that A shares can narrow some of the underperformance to offshore listed stocks going forward.
These analysts cover China, and they have expertise and they have longevity. They've been covering China for some time. So it's good to see that Marvin had comments around how positive the stimulus was from the government. They're lowering rates, they're improving the lending conditions, they're even going to send citizens stimulus checks. They really want the economy to get going. The GDP growth is expected to be 5% in 2024, close to 5% in 2025. That's much higher than the US GDP growth rate. And he believes that this rally is going to be sustained into 2025. It was also good to hear from Stephen, who has some comments that, hey, the sentiment for the week was very positive, but to continue that sentiment, the US election may have a headwind against that sentiment. And I would tend to agree and disagree. I think the China-US tension is real, but I think it's going to take a backseat to the tension we're seeing in Russia and the Ukraine, which has been going on for quite a while. It really needs the US to support Ukraine through that whole conflict. That's a real conflict that can really escalate to a really, really bad outcome. So that I think that has a lot of mind share of Washington. And the second conflict is the conflict with Israel and its neighbors. I think that conflict, again, is already ongoing. It's already been super ugly. A lot of people have been killed. A lot of people have been hurt. A lot of people have been displaced. And it can get uglier. So I think Washington is going to have their hands full. And I'm not a political scientist. I would only expect that Washington is going to have their hands full. And I don't know that they're going to invite one more battle, one more area of conflict from China. If anything, citizens in the US, speaking for myself, would rather take care of the current problems instead of starting a new set of problems with China. I know there's been a lot of talk through the political campaigns about tariffs. It's good to hear that the politicians are, one side is talking about rationalizing tariffs and not just going across the board just to make a blanket statement. That would be quite detrimental if we had blanket tariffs. That's basically a tax on the citizens. So I would hope that whichever side wins, that they take a more measured approach at tariffs, really use them strategically to have the right behavior as a result of those tariffs, but not put a tax and burden on the US citizens. That would just be bad. So in summary, I think the tensions between the US and China are not going to be as bad as historically they have been. If you think about it, for the past year, I don't know that we've been arguing with China a whole lot. And I think it's going to remain that way because we have bigger problems to solve geopolitically. Next, I wanted to share a video from a super investor that I really trust, and that's in Tom Lee. He had comments around the China rally, and it's really interesting. Let me share that with you.
Our stance at Fundstrat is to treat it like a real move.
Okay.
So we did a webinar yesterday for our clients, and Mark Newton really pointed out this is actually a pretty significant breakout because we've moved to levels that you would expect a much bigger retracement. And he was talking about how many of these stocks then kind of approach multi-year highs. So
These are Chinese internet stocks, I'm guessing?
yeah, like KWeb or
Holdings.
FXI. And but it sort of fundamentally makes sense because, you know, at the end of the day, China is trying to restore consumer confidence through a channel. And actually equity markets is one because real estate would be very tough to stimulate here. But
Not now, right?
yes.
Okay.
So there could be a very self-reinforcing cycle because we know there's also a lot of savings in China.
So the Chinese stock market has lost $6 trillion since 2021. It's the worst of the large economies coming out of COVID, coming out of the pandemic. And it's really a situation where you had a stock market that's like 9 or 10 times earnings. Some of these companies have 20% of their market cap sitting in cash. Then the Chinese government comes out and says, not only are we cutting rates, we're cutting mortgage rates. We're cutting restrictions. We're cutting regulation. We want to encourage mergers and acquisitions. I don't know how you do that, but they're going to do that. It's beyond just monetary policy. It's like almost like they want to reshape the way business people in China feel about taking risk again.
Yeah, it's maybe to restore a sense of capitalism and risk taking and initiative.
Do you think it'll work?
I think that we won't know, but in the meantime, it's a little bit like in Europe when Draghi said whatever
it takes.
Yeah,
That was a pretty big moment, and that's what David Tepper was referencing when he said 2010, I think.
yeah, because
Okay.
I think it makes sense. You know, you should be a little fire ready aim just because if you're lucky and it retraces towards its all-time highs, it's a huge move. So I think it's a good calculated risk.
You know any China bulls? Because I don't. The stocks are trading at multi-decade lows in terms of valuation. In terms of the price action, we've got FXI price at multi-year lows with the short interest at 61%. And this is gonna, I mean, this is a lot of firepower. We had the second largest day of inflows yesterday, and the shorts are way off sides.
FXI is the largest Chinese companies that are listed in London, right? That's what composes. So 61% of the float of this ETF was short.
It's unbelievable. And you had a massive gap up 2 days ago. We traced a little bit yesterday, another massive gap up high. You got to cover.
Yeah, and then imagine this in the context where the largest central bank in the world is dovish, and so
Ours.
yes, the U.S. And so people who have the $6 trillion cash on the sidelines or low leverage, this now suddenly looks
Tom
like
Lee
a really good
believes
way
that this
to
rally
have exposure
is a real
that feels
move,
early.
and that it's a good calculated risk to buy into this China stock market. And I feel the same way. If you look at the alternatives are buy US stocks, which I believe are priced expensive. Can they still rise? I think they can. But to expect that, let's say Apple is going to double in value in the next 5 years, I cannot expect that. I don't see it. Would Microsoft double in value? I don't see it. But if you give me a list of Chinese stocks, it's very real. I could totally see Alibaba double in value in a year or two. I could see its peer companies in China double in value over the next 2 years. The upside has great potential. And the downside isn't so bad because these stocks have been beaten down so badly that I think it is a very good calculated risk. So that's the podcast on China stocks. I'm going to keep analyzing this space because I believe this could be the space that really makes 2025 a winning year. It's about time. After 3 years, the China economy is the second biggest economy on earth, second to the US. It's growing faster than the US economy. China is an innovation hub. It is the manufacturing center of the world now. Most of the products that we consume in the US are made in China. And the world uses China as a source of many of the products they use. Certain sectors China dominates in, and they do a great job. The quality is high. Their cities are modern. So this is a great time to consider China for me. And I'm going to really put a lot of time into analysis, and I'm going to put capital to work in China stocks. So that's the podcast for the week. I hope you found it interesting. Let me ask again for your sponsorship and support by becoming a paid member. I would really appreciate your consideration of that. More details are in the details of the video. And again, I would appreciate your consideration of that. With that, let me wish you good success as we close out the month of September and begin the month of October trading. Thanks for watching.